Hi, everybody. Let's look at calculating straight line depreciation for an asset. Accountants like straight line depreciation because it's fairly straightforward. When you do the asset, it's fairly easy to calculate. It's fairly easy to come back behind somebody and see if they calculated it correctly. Many times you'll see that uh, accountants use straight line depreciation for financial statements because it gets a good depreciation and it's fair. And they'll use straight line depreciation for financial statement purposes, and they'll use an accelerated method for income tax purposes. So they can write the asset off more and get more income tax expense. But anyway, let's take a look. It's fairly straightforward. Let's look. Here is an example from an earlier video that we did. And remember the general rule that an asset's cost is everything it takes to get it into productive use. So we have the cost plus everything it took to get it here ready for us. We're now at $12,700. We estimate a salvage value. What's this piece of equipment going to be worth at the end of the life when we're through with it? So we estimated a salvage value of $2,700 and an estimated useful life of 5 years. I'd mentioned on a previous video that if you don't know about where to look for estimated useful lives, the IRS in their information has got estimated lives on everything you can imagine. So we're going to say this is a 5-year piece of equipment. Okay, the formula for the annual depreciation expense, cost minus the salvage value divided by the estimated useful life. So let's plug some numbers in. Okay, so I've got the $12,700 total cost minus the salvage value of $2,700 gives us a depreciable basis of $10,000. That's the term they use, depreciable basis. That's going to be how much of this asset are we going to consume over its useful life. So we're going to use up $10,000 worth, divide it by its estimated life of 5 years, and give us an annual depreciation expense of $2,000. So every year we're going for the next 5 years, or as long as we own this up to and through the 5 years, we're going to take $2,000 a year. Can it be changed? Yes, but let's don't get into that. We're going to keep it simple. Okay, so we've got annual depreciation expense using this formula. Cost minus estimated salvage divided by the estimated useful life gives us our estimated depreciation each year. This is the journal entry. We debit depreciation expense. That's the annual expense going onto the income statement. Crediting, and we're going to credit accumulated depreciation. Okay, accumulated depreciation is a contra account, which is subtracted from the asset account because we're going to keep track of the cost on this thing, and we're also going to keep track separately of how much depreciation we've taken. The difference between those two numbers we're going to see is called the book value or net book value. All right, so let's take a look. All right, the journal entry every year for 5 years. We're going to debit depreciation expense. We're going to credit accumulated depreciation. There's our journal entry. We just took our journal entry here and plugged the numbers in. Okay, the depreciation statement, the income statement is going to show what? Depreciation expense on this piece of equipment for $2,000 every year for 5 years. Okay. What's the balance sheet going to show? It's got a little bit more detail. Now, if this is not shown on the face of the balance sheet, it's got to be in the notes. So sometimes you might see on a balance sheet, you might see under fixed assets, if you see net book value, it's going to say see note so and so. This needs to be disclosed to the readers, the asset cost, accumulated depreciation, and the net book value, because that's important information that the readers of the financial statements need to know. So at the end of first year, we've got the machinery at cost of $12,700 minus that first year of accumulated depreciation of $2,000. You subtract it out, and we've got a book value or a net book value of $10,700. We've got to realize that that has no relationship to what market value is of this piece of equipment. This is just our undepreciated monies that we've got in this piece of equipment. That we've got at the end of the first year, we've got cost of $12,700 minus $2,000 gives us a book value of $10,700 left to depreciate. All right, at the end of year two, what have we got? On the balance sheet on the assets, we've got machinery at cost, $12,700, that's our cost. Accumulated depreciation of what? $2,000 for the first year, $2,000 for the second year, gives us an accumulated depreciation of $4,000. So on our balance sheet, it's going to show on the second year, machinery at cost, accumulated depreciation of $4,000, subtract that out, and it's going to show a net book value of $8,700. And we're going to keep on doing this until we reach that $2,700 net book value that we estimated was going to be the salvage value, unless we get rid of it first. But this is straight line depreciation. Like I said, accountants like it because it's easy to calculate, it's easy to check back on, and it gives a fair estimation of a reasonable amount of depreciation every year that you can prove. Like I said, it's not market value we're going after, but just to show we've got this much money in an asset, and this is how we're writing it off. So this is our look at straight line depreciation, and I hope this helps. So we'll see you next time.